Hello, everyone. David Moore with Tom Moore of Equity Advantage, the Exchange Brothers.
Good morning.
Thank you for joining us. And I want to sort of go back a founder's moment, Tom. So if we go back 34 years and talk about how we were sort of taught to look at this business and what we do and what we should be calling it, the whole deal with straw men, intermediaries, accommodators, QIs, and facilitators. What were we sort of, it was impressed upon us to look at ourselves as one of those. Which one was that and why?
Yeah, we wanted to, and we were encouraged to be a very active participant in the transaction and not just a straw man or an accommodator, but actually a facilitator. So that's what we have always impressed upon people, that we are a facilitator and not just an accommodation company here.
So I sort of look back, think how we got into the business. We got into the business from the application side, and we had used it. We had to use it. We didn't want to pay that tax, right? And so I think we're pretty unique in the business in that we came from that side of it. I think most of our competitors probably either come from the tax or legal world or the escrow world. And I think that's one of the things that really puts us in a different sort of position to the people we compete against. And I think today we have a lot of people that say, well, how do you pick a QI or facilitator or intermediary? And everybody's going to sell their strengths. So what do we typically see as a selling point that our competitors are putting out there versus, and how does that sort of impact our, how do they compare and contrast to what we can do with different issues?
Yeah, so I think that a lot of people try to just market the size of their company, and we're big, or we're the biggest company. We've got we hold the most money, and the problem with a lot of the companies that are of the larger scale is that they are really stuck with certain procedures, and they can't go outside of their little box that has been given to them by their legal people, their legal departments. They're part of much larger firms, and I think that they feel like they have to really play things super conservative. And we are certainly conservative, but we, on the other hand, have worked with enough legal and tax professionals during our careers that and some of the best that we know that are out there in the business. We've been given a lot of different tools that can play a part in transactions that most people don't have. So it comes down to the fact that we are independent. We can go outside the box and give people ideas, and there's certainly a lot of gray area with respect to Section 1031 that can be utilized for a lot of transactions.
So we're looking at one of those transactions that might fall into a gray area, and you think, well, what do you mean gray area? These guys pushing stuff. A common example of a gray area would just be holding periods, right? I mean, it's probably one of the most common questions that we get asked, and how long something should be held, and that's one of those discussions that we would have with the taxpayer and hopefully their tax counsel if they're making changes. And we have people needing to make changes. Just before you sat down, I sort of asked or said we ought to talk about people wanting to buy other parties, family members in some cases, out of common properties. It seems like we've got a lot of that going on these days, sort of consolidation of ownership. And we've got siblings wanting to buy other siblings out of properties. They may be held as limited liability companies or tenancy in common. And obviously in that situation, people are always like, well, so you think, well, gee, how does that deal with timelines and what do we have to do with a partnership transaction to make it fit, and then what do we deal with related parties too? I mean, so in that simple scenario, we've got two different issues that have to be addressed.
Yeah. Partnerships. If people want to exchange out of their partnership position, that's not something that can be done to begin with. They can only do a 1031 tax-deferred exchange out of real estate interests. So even if the only thing that partnership owns is the real property, What they technically own is shares of the partnership, and partnership shares are not exchangeable. So they would have to dissolve the LLC, deed out to their to themselves, or they could have individual LLCs. So if you and I had a partnership that we own together, if we wanted to go separate ways, we either deed out of the partnership to ourselves as tenant and common owners, or we could deed out to, if you wanted to set up your own LLC and I had my own LLC, single member LLCs, we could do it that way and deed out to those entities and then exchange out. Ideally, that's something that you want to address ahead of time. Again, no holding period requirement for these transactions typically, but if you can do so, well ahead of listing the property for sale, that'd be a good idea. So that from the beginning, you're listing property and selling property as an individual owner, not as a partnership. The topic of related parties buying out family members, I think some of that also comes from a period in time where people are not finding a great deal of inventory out there, but they know of a property that's in the family, and well, maybe they'll buy them out and even let them still live there and rent it out to them. That's a tricky situation, because if you've got a family member, a close family member that you're buying a property from, that related party, in order to be able to do that, would have to either do a 1031 exchange themselves and not receive any cash out of the transaction.
So if I wanted to buy you out of one of the properties, or you want to buy me out of one that we jointly owned, one, I could not, if we owned it via limited liability company, we couldn't do it because of the partnership interest. But two, we're related parties as brothers. So if I or you want to buy me out of something, that's going to trigger, as you were saying, I'm going to have to do an exchange also. And
yep. So we'd have to hold it for 2 years first off. But for me to acquire that interest from you, you would have to do an exchange transaction out of that piece of property yourself and use all that cash to go out and buy other property.
And hold it for no less than 2 years.
Yeah. Either that, or if you have a tax liability on the sale to me that is basically equal to what I had in tax liability that I'm deferring through my transaction, and you're paying that tax liability, then that's acceptable as well.
And even in that situation, the fine print of the code says even the related party with that 2-year hold doesn't necessarily always apply, right? It sort of says unless there was no intent to avoid tax, which is 1031 avoidance or deferral, right? It's
deferral.
Yeah, it's deferral. So it's one of those things where even a transaction like that, people think that there's a black and white answer, that hold period. I think one of the most viewed videos we have on YouTube is something titled The Fallacy of the 5-Year Hold. And so what is that in context to? Since we talk about the only really black and white hold in 1031 is not how long you have to hold something. It really has to do, as you said, with intent. But if it's a related party transaction, then we're looking at that 2-year time period, ideally. But where would a 5-year, where's that 5-year come from?
I think the 5-year typically would come out of the whole the holding period for and then also people will hear with respect to personal residences too. They know that there's this 5-year period, but that's not a hold period necessarily. It's a 2 of last 5 years for a sale of for Section 121 on a personal residence sale. But we get that all the time where people call up and I've held the property for the requisite 2 years, or I've held it for the requisite 5 years to do a 1031 exchange, and that's something that has been impressed upon them, but is just simply not the case for almost all transactions.
So the 2 out of 5 applies to what 121 says you have to have lived in it for 2 out of the preceding 5. It's not what the property is at time of disposition. It's just whether you fit that. So you can move out and you have to sell it within 3 years. And we have a lot of people that do that with large gains if they want to sort of break it into 121 and do the overage 1031. And I think the other place that 5-year applies is is if we remember back, was it around 2000 or so, where they implemented a 5-year hold after 121 got put in place. Because remember, right in the late 90s, we had a whole after 121 was put in place in 97, we had a few years there where people were buying a property via 1031, holding it a year, living in it for 2, and dumping it and getting the full exclusion, wiping out any gain. And the government saw that happen, so they put that 5-year hold in there too. So when we look at sort of the fallacy of the 5-year, you've got a couple different situations where you can see where people get confused on it.
Yeah.
But
and you think about that $500,000 exemption for Section 121. I mean, that's been around now for close to 30 years. It's ridiculous they have not changed that. So hopefully that will be something that is updated in the near future, because you're right. We have people that will, in order to get out of their personal residence without having huge tax liabilities, they'll end up converting it to a rental property and maybe renting it out for 2 to even 3 years, so that they can take advantage of both the Section 121, because they still would have held it or lived in it for 2 of those preceding 5. But they can take advantage of Section 121 and Section 1031 now that it is an investment property or rental property for them. But yeah, people will have to jump through some of these hoops in order to get out of a property without huge tax liabilities.
So I think that sort of that discussion falls back into the initial question I had or comment about intermediary, accommodator, QI, facilitator, right? I mean, a lot of it's sort of, I know you and I have been frustrated through the years because we've got into the game, early enough to have the URL 1031exchange.com, if that means anything. But we started the company in 91. And if you look at the evolution of this business, it was pretty obscure when we started. And then basically it's becoming a commodity, it seems like, and we it's frustrating at times to be sort of thrown in the bucket with all these people that just say, hey, we'll hold your money, use us because we're huge, when everything we've just been talking about are really gray areas that need to be discussed. And I think we're blessed to be at a point in our life where we don't have to do every exchange. And I know you take pride in your ability to say, hey, maybe you shouldn't do the exchange today, or maybe it's not the right thing to do. But to understand, we were taught, I was laughing. I pulled out that End Games article that our mentor actually wrote in 1989 about sort of chess end games. But it's at the end of the day, we can say you can swap till you drop, but really he always impressed upon us it's not a tax or legal decision. It's purely an investment decision, that you're choosing to do this, and you're doing it because you're going to keep your money yours. And we like to say you've worked hard for your money. We're going to work hard to keep it yours. So I think this is really important for people to understand. You sort of, get what you pay for when you're working with an accommodator. They're going to hold your money. They're going to put a deal together, but are you really getting the most out of that transaction? Do you really know what's possible? Because so often, how often do you take a call where somebody says, well, I didn't know, or I didn't know I could do that, or I was told I couldn't do that?
Yeah, well, there's, on the facilitation point, there's been times in our history here as a business where we have been a large volume business, and it's not something that I think either one of us likes that much. I mean, we certainly love doing deals, but when you're doing so many transactions that you can't spend the time with the client that you really know they need to have taken with them, then you don't feel like you're servicing them as well as they should be serviced. Had a person call in yesterday that is a long-term client, and they were doing a transaction where it was one of these. It was as a partnership, and only one of them wanted to exchange. So that was the beginning of the conversation. Was you need to split up the partnership and deed out to the 2 of you as individuals now. And now one of you can exchange. That doesn't have to. So that was the beginning of the conversation. But as we get further into it, he decides he had told me that he wanted to take. He had about, for his portion was about an $800,000 sale. He had about a $500,000 basis, $300 in gain. He was only getting about $150,000 in cash out of the transaction, and wanted to use all of that to go into a 50% leveraged DST property. So he was going to be going from an $800,000 property down to a $300,000 property, which in some instances, if his basis was low enough, it would still make sense. He could do a partial exchange. Maybe if he had a $100,000 basis, he'd still be deferring taxes on a couple $100,000. But his situation, he had that $500,000 basis, was only planning on going into something for $300,000, and it ended up he's not going to do an exchange this time around. He's got stuff coming up in the future that he's got more equity and will be doing transactions on again. But you spend enough time with somebody, and now they realize for this transaction it wasn't the right fit to do an exchange. Where I know that a lot of companies might take the phone call. All they want is your information. They'll set up the exchange, and now he'd be in the middle of the exchange, finds out he doesn't need to do it. He might be with that money sitting with the company for 45 to 180 days, depending on what happens with the transaction.
Yeah, imagine if he's inside the 45 days, he finds out he shouldn't be doing it, then at least he could terminate it and get the money back on day 46. But if he ID'd something and then found out he couldn't do it, then he's stuck 180 days without that money.
Yeah, you could certainly always buy the property, but he's out exchange fees, which the exchange fees are, as we know, they're not the largest fee on the settlement statement ever, but it's certainly not something that he would need to do in this situation.
Well, I think of those transactions like that, and I had the one I mentioned. If you've seen our podcast, I've mentioned it recently a couple of times because I think it's a great example. We had one of our clients wanting to buy a sibling out. The sibling was wanting to just take the money and go buy some Wall Street stuff. I guess spoke with the financial advisor. And I'm trying to explain to the client that wants to do the exchange that the only way he can do it is if his brother also does an exchange. And then it's really taking that time to understand, okay, what does the brother really want? If he's being promised a 3.5% to 6% return on Wall Street, is that consideration after they paid 40% in tax on the gain? It's going to take a long time to be made whole. And in that particular scenario, I really like that, and we don't sell any of these investments. We just work with them day in, day out, but a 721 UPREIT, because that would allow him, one, it would allow the primary client, the one that wants to do the exchange in the first place, to complete the transaction. It would allow the brother to exchange into the DST, which rolls into the UPREIT, and then you can sell through that tax treatment. It's pretty preferable. He'd have to sit tight for a year or two, but then he'd have all that money. He can sell through the basis first with no tax and take that money, go buy Wall Street, and is a lot better scenario. But I think that, back to your comment on that basis of, the basis of 5 and spending 3, we like to sort of say, hey, the exchange is only going to make sense if you're spending money over that basis. And 1031 is not all or nothing, but the first thing you want people to understand is what their tax liability is. And then having tax liability is one thing, but really taxes owed is quite another too. So, we're looking at it's March of March of the year. So if this guy triggers the gain today, he's still got 9 months to look at how to mitigate the tax consequence.
Yeah, certainly has time to do some planning. And I had brought up with him also, wasn't sure if he had bought into DSTs before or not, but he was looking at DSTs that were 50% leveraged, which is pretty common in the industry to have that type of property. But if I did bring up, just in case he was unaware, is if you're not set on a particular DST, that you can go into ones that are much more highly leveraged, that are termed zero coupon DSTs, and they might be leveraged somewhere around 80-85% sometimes. And if he was taking his 150 and going into something like that, he could have still full tax deferral on that transaction. I can do my math quickly there, but it would come out pretty good for him, I think, in the end. And so it's not going to pay out monthly distributions to him, but then again, he doesn't have to pay $100,000 in taxes.
So we have occasionally, once in a while, people will say, well, gee, my number is 500, let's say, and this is 450. Should I pay the extra money so I don't have to pay any tax? And to our response is going to be obviously no. Every dollar more that you spend that you don't have to costs you $1. If you don't spend it, maybe it's 40 cents in that gain. But I think people need to understand that one, what good is tax deferral if you're buying something that's not going to work out? You don't want to do that, because what good is tax deferral if what you buy goes away? But two, think about the people and think about how often through the years, and we were talking about the 5-year hold earlier, and maybe seasoning with an acquisition of an investment property that gets turned into a primary residence. I think that's a conversation. Yes, you can do some of these things, but is it something that's right for you? And what I mean by that is, you got to look at the tax liability. If you're exchanging into this property, ultimately you want to convert to a primary residence, we're probably typically going to tell them you ought to hold it for a year or so before you do anything with it, right? So, let's say you do it and you're having to live someplace else for a year to wait to get into that thing. What does that cost you? If that's $3,000 a month, maybe that's $40,000 that you spent living someplace else. What's the tax liability? If the liability was $50,000, is it worth $10,000 to you to put your life on hold for a year? So I think that's once again those conversations that we really enjoy having to sort of rationalize what these people are doing. And we were sort of taught, hey, where are you today, and where do you want to be in 2, 5, or 10? And I think that's one of those things that you and I both take pride in with the company, is like we try to rationalize those transactions, say, hey, yeah, you can do these things, but do you really want to do it?
Yeah, and then on the topic of that new home that's converted to a primary residence, a lot of people still think that you can do, as you said earlier in the conversation, where they rent it out for a year or two, move into it, stay there for a couple of years, and then they can take that 121 exemption. It just doesn't work out for them. And so it's a good play if you're planning on living out your years in that property. But if it's not your long-term retirement home or something like that, it usually won't work out in your favor.
So if you're curious what Tom's talking about, on top of that 5-year hold, you're going to be subject to something called the Housing Assistance Tax Act of 2008. So we have a lot of people that still think that's a great strategy to acquire that property, season it, move into it, then sell it, and it's not something that's going to work out, as Tom just said. So just be aware of that, and really understand that sort of the devil's in the details on this stuff. And that's why we don't want to just take your name, address, phone number, email address, along with the escrow people to put your deal together. There's lots of situations that come up, and we really think it's worth your while to take and invest the time, sooner rather than later. And I always sort of come back to, I was talking to somebody with big boats. It was the term slow is pro, right? Because if you hit something, it breaks things. So you got to go slowly, and everybody thinks they're going to be cool, fast in and slam in reverse and all this, and it just doesn't work in the big boat world. But you think about, Tom and I were both dive masters and rescue divers. You think about in a prior life. But you think about what we were taught there, and what's the golden rule in diving? When there's a problem, what do you do?
Yep, you just got to relax, and everything's going to pretty much take care of itself at that point in time.
So stop.
Yep, stop what you're doing, and it's I don't know if we don't want to get into it that much, but the classic was, if you're in a kelp bed and you get tangled up in kelp, and people will panic and they'll make things worse. But if you just stop and sit for a minute, the kelp just all kind of floats off of you.
Wasn't that amazing, first time doing that? I mean, you literally wrap yourself up in the stuff, just spin and spin and spin and spin, and you just stop.
My son is going through fire academy right now, and he was telling me about, they've got all their apparatus on, and they're going through a dark tunnel that's been made, and there's cords that go all over the place. It's designed so when you go through this, you're getting caught on everything. Yeah. And it's just that diving just came to mind instantly, and thinking about kelp beds.
But it's the panic, it's the thrashing that causes the problem with whether it exhausts you or you drown or it makes the tangle worse, all that. So, and how often do we have people that just feel like they're forced into making something happen? And with 1031, I mean, one of the real sort of opportunity costs of 1031 is you do have hard timelines that have to be met. So I know that we both really, when we have the opportunity to talk to people in advance, it's like you just try to get them to slow down the transactions, ask for the time they feel they need to get where they want to go. But don't get yourself, and I always think of Dad. Think about how many times in a closing, Dad would be so frustrated. He's like, it's a conspiracy against me because he's got a stack of loan docs, all these papers that he's seen for the first time at closing. He was convinced it was conspiracy against him alone. But you think about through the years how many times we have conversation with somebody that's really looking at those documents at closing for the first time. And our position on it is, if when do we need to be involved? We need to be involved anytime prior to closing. When do we want to be involved? When you're considering a sale. But worst case, when you get escrow open, so we can get our docs together and get them out so you can look at them. You're not going to sign anything or pay anything till close. But I mean, there's a fair set of amount of paperwork just in our transactions that if you're waiting till the 11th hour to do it, you're doing yourself a disservice. But it's really rationalizing the transaction and asking the questions early rather than late.
Yeah, and asking for an extension can really give people a lot of relief at times, and a lot of people don't want to do that, or they don't know that they could even do that. They can't even ask for that. But we'll have a lot of people that will request a week or two extension on the closing, and it just gives them enough time to settle down and be able to make the right decisions. It brings up, I think about this quite a bit. We have a lot of people that will be selling a piece of property, saying my closing's coming up on this date, and but I'm going to be out of town for the next month. So and we're saying, oh, another one. So during most of the entire identification period, and they haven't found anything yet, most of that period of time they're going to be gone out of town. And talk about making it tough on themselves, where if they could arrange for that closing to happen either earlier or later after their vacation is done, or change the vacation dates, they're going to eliminate a lot of stress. And who wants to be on a vacation with a 45-day ID period looming?
Not me. And that's that opportunity cost we're talking about, right? So you've got to really, as we said with the diving, it's plan the dive the plan. And in 1031, you really need to take the time to, invest the time to figure it out in advance. Pick up the phone and give us a call. I mean, as far as a conversation in 5 minutes, you can dig through a week's worth of emails back and forth. So it makes sense to take the time, really look at what's going on and rationalize it, because there's lots of options up there that potential pitfalls, but there's lots of opportunities that are also made available. And that's, we like to say that we'd like to provide opportunities and solutions. And that's part of the facilitation of the exchange versus just acting as a passive QI or intermediary accommodator in the transaction.
Yeah, and everybody in here is trained to ask those questions that are needed. So whether somebody's talking to us or any of the other consultants in here, or facilitators and exchange coordinators in here, you're gonna be answering a lot of questions that may make a big difference in your transaction.
Well, thank you very much for taking the time with us today. Hope you find it helpful. And I always like to say the only dumb question is the one you don't ask. So if you got questions, whether you're working with us or somebody else, you're looking for some guidance on something, don't hesitate to reach out to us. Dave and Tom Moore with Equity Advantage, the Exchange Brothers, 1031exchange.com. We look forward to talking with you soon. Thank you.